You've probably heard about Enron's collapse and how it destroyed thousands of employees' retirement accounts. What you haven't heard is that during Enron's prolonged collapse, a select group of people became millionaires. While workers watched their life savings evaporate, these individuals executed profitable trades. Today, we're going to reveal exactly who they were and how they profited from Enron's downfall. Number 1. The bankruptcy filing day. Let's start with December 2nd, 2001, the day Enron filed for bankruptcy. By 9:30 a.m., employees were already panicking as the company filed for Chapter 11 bankruptcy protection. Most thought this was the end of everything. What they didn't realize was that this chaos created the perfect opportunity for those. Number 2. The secret players. Here's where most people get the story wrong. The winners weren't random lucky traders. They were hedge fund managers who had been shorting Enron stock for over a year. Jim Chanos of Kinnikos Associates had borrowed millions of Enron shares at $80 each, betting they would crash. When the stock hit $0.61 on that final day, he bought back those same shares for pennies. The math is staggering. For every share he had shorted at $80, he kept nearly $79 in profit. Chanos alone made an estimated $500 million from Enron's collapse. But he wasn't the only one who saw this coming. Number 3. The Enron collapse. Enron filed for bankruptcy on December 2nd, 2001, but the major trading opportunities came during the months-long collapse that preceded this filing. As accounting scandals emerged throughout 2001, Enron's stock price plummeted from over $80 to under $1. The bankruptcy filing itself was largely anticipated by the market. Number 4. The short sellers' windfall. The profits from Enron's collapse were substantial but spread over months, not a single day. As Enron's stock plummeted from over $90 per share to under $1 throughout 2001, short sellers collectively made billions in profits. However, most of these gains came during the major price drops earlier in the year when there was still significant value to capture, rather than from the final trading session when the stock was already nearly worthless. While some hedge funds and institutional investors made tens of millions betting against Enron, the profits were primarily institutional rather than individual windfalls. Number 5. The information gap. But here's the part that should make you angry. Some of these profitable trades weren't just lucky guesses. Institutional investors, including hedge funds, often received detailed research reports questioning Enron's accounting practices well before retail investors became aware of the problems. While regular investors were still buying Enron stock based on glossy annual reports and positive media coverage, sophisticated investors had access to more critical analysis that raised red flags about the company's financial engineering and off-balance sheet partnerships. Number 6. Limited profits from prediction. While Enron's collapse in 2001 created opportunities for short sellers, relatively few investors successfully predicted and profited from the company's downfall. Most institutional investors, including hedge funds, were caught off guard by the accounting scandal and rapid bankruptcy. The few funds that did short Enron stock made profits, but the notion that this led to billions in new assets under management is overstated. Number 7. Information asymmetries in markets. Financial markets operate with inherent information asymmetries where some participants have access to better information than others. While markets serve legitimate functions like price discovery and capital allocation, these information gaps can create unfair advantages. The Enron scandal exemplifies this. Company insiders engaged in systematic accounting fraud while selling their shares, leaving employees and uninformed investors to bear massive losses when the truth emerged. Number 8. Why it matters today. Here's why this 20-year-old story still matters. While many reforms were implemented after Enron, institutional investors still maintain significant advantages over retail investors. They have access to better research, faster trading technology, and greater capital resources. However, Regulations like Sarbanes-Oxley have improved corporate transparency, and retail investors now have better access to information and trading tools than ever before. Number 9. Enron's collapse and systemic issues. Enron's bankruptcy in December 2001 exposed serious flaws in corporate accountability and employee protection. While executives engaged in accounting fraud and sold shares before the collapse, many employees lost retirement savings invested in company stock. However, the primary issues were corporate fraud, regulatory failures, and inadequate retirement plan diversification, rather than simply different classes playing different games. The story of Enron's final day isn't just history, it's a blueprint that's still being used today. Every major market collapse creates the same opportunity for those positioned to profit from disaster. The question isn't whether this will happen again, but whether you'll be on the winning or losing side next time. If this opened your eyes to how the game really works, hit that subscribe button, because understanding these hidden systems is the only way to stop being their victim.